Of a global recession are escalating tonight after a fresh warning from the International Monetary Fund. While Australia won't be completely spared, our nation is expected to avoid the worst of the downturn.
Things are bad and we wish we had better news, but it looks like things are going to get worse for the economy.
Investing for recession. If you feel like a recession is incoming and are worried about your investments, then stick around. Investing for recession is going to be a key topic over the coming year or two. Investors have now felt pain in all areas and have now waved goodbye to any chance of a recovery and are now bracing for impact. In this video, I'm going to talk about 3 critical points of investing for recession. Okay, first off, this isn't financial advice. You're responsible for your own decisions. Please don't take this as me saying what you should or shouldn't do. The first thing I want to say is that people don't have enough cash in their bank accounts. I've been looking at people's bank accounts for 15 years and I can safely say that there is a large amount of people with not enough money in their bank accounts. Everyone has their own safety level here, but for me, I'm looking 6 months in advance. One of the earliest mistakes I made is to put too much money into investments as soon as I had the money. I always found myself with not enough cash to buy things when the price was cheap, and unsurprisingly, you can buy things for cheap in a recession. Speaking of recession, guys, it looks like we're going into one next year, and in the coming weeks, I'll be posting videos on what could be coming for 2023, so please subscribe to the channel to see these videos. Anyway, going back to the point of holding your own cash. The main reason you hold cash is that if something unexpected come up, you would have the means to handle it financially. So it's not just an investing thing. This massively ties in with investments because a large part of investing is looking to the future and then being able to provide for that. If you don't have the means to look after yourself for the next 3 to 6 months, for example, then how are you going to invest for the future? The next thing I want to say about investing for recession is that, in my opinion, people have forgotten what diversification is. So let me dumb it down. People only want to invest for the good times and not for the bad. That is where mistakes get made. For example, there are a lot of people right now regretting buying investment properties with a 3.5% rental return when the interest rates are now 5% plus. I'll get into the debt bit a little bit later on in the video in a bit more detail. First, let's use an example of people not diversifying. If I was Japanese and had 100% of my wealth in property in the late 1980s, I would have been wrecked unless I could hold all of those properties, which is highly unlikely because property bubbles are fueled by debt. The Japanese economy is caved and hasn't recovered for 30 years. I mean, just look at this chart. The property market's taken 30 years to get back just to where it was. Simply amazing. Now, if I'd done a small amount of diversifying and, for example, owned some US stocks, the story would be a lot more different. Even with the market crashing this year, it's still up 1100% over the same period of time. Just crazy. Again, this isn't advice. I'm not saying go out and buy stocks. It's just an example to show why diversification is important. Let me explain it further in a very basic way. Let's say you have your wealth spread evenly across assets: cash, stocks, bonds, property, gold. Do a hypothetical, and I want you to imagine that all of the wealth in the world is distributed evenly in these assets. Now, imagine little old me. I've got all my assets equally diversified between all the asset classes, and every year or so I'm just checking to see that if one asset class has gone up too much, I'm distributing it evenly so that I'm diversified. Cool, good on me. Let's say a black swan comes along and stocks do a 1929 and drop 85%. Whatever happens here, I'm still distributed evenly across 100% of the wealth. For those distributed unevenly, maybe they won big, but probably more likely is that they lost big. The wealthy always look to protect first, and diversifying is a good way to do that. Another way to invest for recession is to make sure you don't have too much debt. I feel like a broken record here, but history tells you that too much debt will either set you back decades so you can't catch up, or it'll just wipe you out. People have horrible attitudes to debt in this country, and there's not much more I'll say about that, apart from if you have enough cash, then you can possibly weather the storm of higher interest rates. The biggest risk I see here is that this cycle, the peak isn't really that high. It's more the next wave that could really catch people off guard. Guys, if you're still dialed in, I suggest you go and watch my previous videos on the property market, as that's where most of you guys are going to be invested. If you're interested in this stuff, I post videos about the economy, money, property, and home loans, so please like and subscribe for more interesting content.